Welcome back to the Deep Dive. You've handed us a fantastic set of sources today, and we're diving straight into the inner workings of how a national economy is managed.
We are, and we're focusing on the Reserve Bank of India's power over, really, the flow of money itself.
It's fundamental stuff.
Absolutely. It's the foundational material for understanding financial stability. So our mission is to take these, really detailed sources on monetary policy and just break them down.
Unpack the mechanism, who's in charge, and what they're trying to do.
Exactly. And translate it all into clear, insightful knowledge for you.
Okay, so let's start right at the top. When we look at a massive economy like India's, the sources tell us it basically runs on two big engines.
Right, two engines.
The first one is fiscal policy. That's the government side of things. The annual budget, taxes, big spending projects.
All that. And the second engine, the one we're deep diving into, is monetary policy.
Which is run exclusively by the central bank, the Reserve Bank of India, the RBI.
And that second engine is, well, it's vital. I mean, monetary policy is often called the single most critical topic in financial awareness.
Why is that? Why so critical?
Because it really dictates the cost of money and the speed of growth for the entire country. And a helpful thing to remember is just its timing.
It's rhythm.
Yeah, it's rhythm. The policy is reviewed so consistently every 2 months that it's picked up a nickname. People just call it the bi-monthly policy.
So 6 times a year, that's the normal drumbeat we should expect, starting April, then June, August, and so on, right through February.
That's the normal schedule, yes, in normal conditions.
But I have to ask, is that schedule, set in stone? Can they change it?
And that's where the important nuance comes in. The maximum number of times they can review the policy is, well, it's not fixed.
It's not.
And that's deliberate. It gives the RBI crucial flexibility for when a crisis hits. Your source material actually cites a perfect example.
COVID-19.
The COVID-19 period in 2020. The economy was changing so rapidly that they had to announce the policy a remarkable 7 times that year.
Wow. 7 times, so they can ramp it up when needed.
They have to. But to your point about things being set in stone, there is a minimum requirement.
Okay, so there's a baseline for accountability.
Yes, exactly. The policy has to be reviewed at least 4 times a year. That's the legal mandate.
So a minimum of 4, a normal pattern of 6, and an open-ended maximum if things get chaotic.
That's the framework. It's built for both stability and crisis.
Okay, so that's the when. But the timing is only half the story. The real question is who? Who exactly is in that room making these huge decisions?
Right, and that brings us to the Monetary Policy Committee, the MPC.
The MPC, so this is the key body.
This is the body. It was established back in 2016, and it came from the recommendations of the Urjit Patel Committee. It really institutionalized a process that used to be a lot more messy.
And what's the structure of this committee? Who's on it?
It's made up of 6 total members, and it's designed for balance.
How so?
Well, 3 members are appointed by the government of India, and the other 3 are appointed directly by the RBI.
A 3-3 split.
A 3-3 split. And the chairman, the person who runs the meetings, is always the governor of the RBI. No exceptions. The members themselves serve a 4-year term.
The sources point out that the very creation of the MPC was, well, it was born out of a major political struggle.
Oh, it really was. Understanding that background is essential. Before 2016, these decisions were made by the entire RBI board.
Which was huge, right? Something like 21 members.
Exactly, 21 members. And you can imagine trying to get a quick, decisive consensus from 21 people in a crisis. It was slow and cumbersome.
So what was the conflict?
Well, the sources highlight this friction that really ramped up around 2014. The government at the time proposed something called the Indian Financial Code, or IFC.
And what did the IFC propose for monetary policy?
It proposed a 7-member committee, but with a critical 4-3 split. 4 members from the government and only 3 from the RBI.
A 4-3 split.
Yeah.
I mean, that would have effectively given the government veto power over the central bank.
It would have. It would have seriously eroded the RBI's independence. And as you can imagine, that created an enormous amount of conflict with the RBI governor at the time.
It was a genuine power struggle.
The huge one. And so the eventual structure we have now, this 6-member 3-3 split, that was the elegant compromise. That was the solution from the Urjit Patel Committee.
It guarantees the RBI always has an equal voice.
It guarantees that monetary decisions are made with expert input, not just, for political convenience. It's a crucial balance.
Okay, so we have this balanced 6-member committee. What is their core mission? What is the specific mandate the government has given them?
Their mandate is very, very explicit. It's inflation targeting.
Inflation targeting.
They are legally tasked with maintaining 4% annual inflation in the economy, and that mandate is currently set to run until March 31st, 2026.
4%. That number seems really specific. Globally, you hear about most developed economies targeting 2% inflation. Why is India's target higher at 4%?
That's a fantastic analytical question, and targeting 4% is it's very strategic for a developing economy.
How so?
To get the kind of rapid growth and job creation you need for, national development, you need a bit of, well, grease in the system. Controlled, moderate inflation is that grease.
So it encourages investment.
It does. Targeting 4% signals to businesses that prices and wages are likely to rise predictably. That incentivizes them to invest and produce more, which helps meet the demand of a growing population.
So 4% is the sweet spot. It's enough to fuel growth without letting the economy overheat.
That's the goal. But of course, the real economy doesn't always cooperate.
Right. Especially with global factors.
Right.
And that's where this tolerance band comes into play.
Yes, exactly. So they have a target, but also a range. The upper tolerance is 6%, so 4 plus 2. And the lower tolerance is 2%, 4 minus 2.
And this band exists to account for external shocks.
Precisely. Think about the Russia-Ukraine conflict example that's in your sources.
Okay, so that conflict starts. Global supply chains get massively disrupted, and crude oil prices surge.
Right. And when crude oil costs more, transportation for everything costs more, rice, medicine, steel, you name it.
Which inevitably pushes up the final price for consumers.
Of course. And when that happens, inflation jumps above 4%. The RBI can't control the global price of oil, so the 6% ban is a recognition that sometimes these global shocks will make that 4% target impossible to hold strictly.
But protecting the floor, that 2% lower tolerance, is just as crucial, isn't it? The sources make a really powerful point that deflation, when prices are actually falling, is arguably the bigger danger.
Well, much bigger.
Why is that? I mean, intuitively, falling prices sound like a good thing for consumers.
It sounds good, but deflation is a symptom of economic collapse. Low inflation or falling prices means demand is weak, people don't have money to spend, or they're too scared to spend it.
And if demand drops,
then companies stop producing. They can't sell their goods for a profit. So what do? They cut jobs. That leads to mass unemployment.
It's a vicious cycle. Lower prices mean less production, which means fewer jobs, which guarantees even lower demand tomorrow.
That's the deflationary spiral. With high inflation, at least money is flowing and jobs exist. When you hit sustained deflation, production just stops. The whole economy grinds to a halt. It's a sign of a deep recession.
So this really highlights the two fundamental and sometimes conflicting objectives of monetary policy.
Yes. On the one hand, they have to promote growth and development, G&D.
And on the other, they have to maintain financial stability by keeping inflation and deflation in check.
And that's the constant balancing act. To promote growth, that's objective. 1, the RBI has to encourage a continuous flow of money into the economy.
Usually through cheaper, more accessible loans from banks.
Exactly. And they try to direct that flow to key high-impact sectors.
Which sectors are we talking about?
The ones with the biggest ripple effects. So agriculture, education, housing, and micro, small, and medium enterprises. The MSMEs plus large industries.
These are chosen because a little investment there goes a long way.
It has a high multiplier effect. It creates the most jobs and gets capital moving the fastest.
Let's use the examples from the sources to make this tangible. So the RBI encourages a cheap loan for a farmer.
Right. And that's not just one transaction. That farmer used the loan to buy new equipment, better fertilizer.
It's a better harvest, makes a profit, and then maybe buys a new tractor.
Which immediately pumps money into the tractor manufacturing industry. That creates jobs there. Those new employees get paid, and what do? They spend it. Maybe on their kids' education, maybe on a new home.
So that one loan kicks off a whole cycle of growth.
A self-sustaining cycle.
Yeah.
It's the same with the housing sector. When the RBI helps keep home loans cheap, it's not just about building houses.
No, the construction of one single house creates income for dozens of people.
Think about it. The sand and gravel suppliers, the cement companies, the laborers, masons, carpenters, electricians, plumbers.
It's a massive employment engine.
It is.
Yeah.
So that's the growth and development side. But the whole time, the RBI has its foot on that gas pedal, pushing for growth.
They have to manage objective 2, financial stability.
Right. And that is all about managing the money supply. Or, in economic terms, managing liquidity.
Liquidity. The source uses a great analogy. It's like a national water reservoir. It has to keep flowing.
It has to. And the RBI's job is to make sure that reservoir is never too full, which would cause a flood, or too empty, which causes a drought.
Okay, let's look at the flood scenario first. High liquidity, too much money in the system.
So if that reservoir overflows, maybe the government prints too much currency or banks are lending way too aggressively, demand in the market just explodes.
And supply can't keep up.
Not that quickly. So you have way too much money chasing way too few goods.
The result is inflation. Prices shoot up.
Exactly. The source has a perfect, simple illustration. Imagine 100 super wealthy people suddenly show up, each with, say, 500 crore.
Okay.
And they all decide they want to buy the one chartered plane that's for sale.
That sudden, massive demand for a single item
Causes the price to double instantly. That's inflation in a nutshell. And we have, real-world warnings about this. Countries like Zimbabwe and Venezuela where they just printed money relentlessly.
and it led to hyperinflation and complete economic breakdown.
Mm-hmm.
Okay, so that's the flood. What about the drought? Low liquidity,
Too little money. Well, we've already touched on this. If there's not enough money, demand falls off a cliff.
which means companies reduce production, they start losing money.
And then comes the unemployment, the layoffs. And that ultimately leads to deflation. The MTC is constantly monitoring the flow of money to stop either of these extremes from taking hold.
So to just summarize their core function then, the MPC diagnoses the problem,
Is there too much money or too little?
and then they act. If there is inflation, too much liquidity, the RBI has to step in and actively remove that excess money from the market.
And